Happy Tuesday. Welcome to the Investing Master Series. My name is James Boyd. Alongside me is Barbara Armstrong in the chat. Welcome her and all of you here today on this Tuesday. Here we are, February 10th, and hopefully that nice weather is coming your way. Just real quick, Barbara and myself and all of us coaches, we do post educational content on X. So we invite you to actually join us there. We post educational examples and also announcements there. Now, just real quick as we get started, Investing Master Series, we'll spend kind of an equal amount of time between stocks and options. So just a quick reminder there that this is not just an option class. We'll talk about stocks. We have some past examples of stock trades we need to look at, and we'll talk about some option examples as well. Hence the word investing, okay? And also remember when we talk about examples, if we bring up options, remember that options carry a high level of risk and not suitable for all investors. When we talk about examples, remember the information we talk about here is provided for general informational purposes only. Also, the examples will be done in the PaperMoney software application, okay, for educational purposes only. We're going to simulate trading. And also remember that investing involves risk, including loss of principal. When we also talk about, let's say, short options like covered calls, okay, or let's say cash secured puts, we are talking about American style options, which means there can be an assignment prior to expiration. These are not European options only at expiration. Okay. Now that might not necessarily be a bad thing if those were assigned. Just kind of, you got to have to know that before you get in. Is that okay if that were to happen? Now, also remember that today, I want to give you a quick reminder of some up and coming workshops. Number one, we're going to be in the San Diego area, right there at the Marriott Marquis San Diego. That's a one-day event. That's a market drive. We invite you there if you're a Schwab client, free, right? And you're going to see that's a one-day event. You're going to have a two-day event right in Denver, March 27th, 28th, right at the Gaylord Rockies Resort. That is technical analysis the first day, option strategies the second, and also last to highlight is the Dallas Advanced Options, the April 10th and the 11th, the Gaylord Texan Resort. You can find that information by seeing more information about it as far as the agenda and also how to sign up right at schwab.com/events. And also you got to remember is that when you teach it, let's say take a webcast, it's different when you go to a live event. Okay, you really want to kind of get all of it. Learn from the online course, learn from the webcast, learn from the in-person events. It actually does pat down your learning and also allows you to learn in different angles, which helps your learning. Now, also remember, we'll talk about the markets here just briefly. Want to kind of take a look at prices, indexes, sectors to highlight. We're going to then talk about some new positions up front, and then we're going to backfill, talk about some past examples that we need to look at because option expiration is next Friday. And some of these positions are coming down to the wire. So we'll talk about that. But we will talk about some new positions first off. Now, quick look, just real quick. Let's start with just real quick the SPX. Okay. Now, when I take a look at this chart, let's look at the SPX really on a standard chart, which is this is the normal chart we look at, a 10-20 whole moving average. And then we'll look at this in terms of like slowing it down a little bit with some different moving averages. If we look at the price, I mean, just go back to where we were 3 days ago. Well, we actually had the price down near the bottom of the range, okay? And if you look at that bottom of the range, we didn't stay down there for very long, and we snapped right back to the upside. And here we are. I mean, this morning, we were within, 16, 18 points or so of a brand new high. Now, what could be a driver to this, right? Well, it wouldn't take very long to recognize if we had just woken up and I could barely see straight, okay? When I look at the futures, first off, we see the Japanese yen, which has been moving to the upside. Now, remember, I said before in the ETF class on Friday, watch where the money is flowing, okay? I mean, you got to watch that. Japanese yen has actually been moving to the upside, which probably tells us Japanese stock market might be moving up as well. Maybe it has, okay? So keep an eye on that. We also see when we look at ZB, we're talking about bonds here, okay? We got prices up. If you got prices up, you got yields down. Now, here's the deal. If you get yields going down, that can push equity values up. Here we are in the equity class. Voila! That might be a welcome sign. So I think if there's a tailwind to the markets in general, it's getting rates to be pushed down. Now, that rates being pushed down could actually help some of those utility areas. It could help the real estate areas. It will include home builders in that. So keep that in mind as well. So when we look at the SPX, if we pull up this chart on a weekly chart, this is looking at a 10-week moving average, 10-week exponential moving average, 30-week simple moving average. The comment last week was, why don't you talk more about being bearish? It's the simple answer, because we don't really see a bearish market here. And if this week holds, these are weekly candles. We had 1 week down, we had 2 weeks down, and if this holds, we have another 1 week down and then followed by a green candle. Now, that's if this candle can hold here. So I will talk about bearish strategies when we think the market is bearish, when we can see it. We do not see that as far as being predominant. Okay, maybe minority examples, but not the dominant trend is bearish. No, I haven't seen that yet. Now, we've talked about things like cover calls, verticals, things like that might not be as bullish, maybe more neutralist type of trends, cover calls, etc. But we don't see bearish right here. Now, when we actually take a look at, let's say, go back to just real quick, these other ones, NASDAQ, which was the one which was roughed up the most, it's even actually reversed back to the upside a little bit, more in the midpoint of the channel. SOX, it's actually crossed over, not crossed over yet, but actually closed above its 20-period moving average yesterday. This morning, really a midday retest, if you will, to the middle of yesterday's range. Could it actually make a hold from that discussion yesterday? Now, the one I want to highlight, which we'll go to in just a moment, is probably looking at ON, and that got through the earnings. This was the one that was yesterday, had earnings, was down 5 in the after hours, and then closed down at maybe about 3 o'clock, down 3, I don't know, probably 9 Eastern last night. And this morning it was down 2, then down $1.50, and then this morning it rallied back up. This is one that some investors might keep an eye on. Could that hold the 64.5 level, and could it extend? Luckily, not too much movement on that. I want to come back to that in just a sec. But probably the chart that we want to look at is Dow Jones. We were just at 50,000. We went to 50,500 on the Dow Jones. These large and mid caps continue to be a focus of investors. And also, if we look at the last one, what about the small caps? Well, they're not that weak either. If someone said, I'm waiting for a breakout, the breakout was really on February 6th. If someone said, I'm waiting for the moving average crossover, that happened yesterday, okay? Now, someone might say, well, it's not doing anything here today. Not every day is going to be a smash to the upside, okay? Some days is just about consolidating and holding the levels without falling down below them. Now, the area that we need to actually address is kind of just talking about just quickly the gold and silver briefly and oil. Now, remember we said that we saw a tilted up W. The tilted up W is where we drop down, rally back to the upside, fall back down, and then, now how many of you saw that pattern before I drew this up? Notice that low right there is not as low as here, okay? Now, someone might look at this and say, I don't really see anything. Well, let me help you, okay? If we get above 51.12, that is in the shorter term sense a higher high. You might say today it's bearish. Be very careful with saying something like that. Bearish. Like a bearish trend? If I go spend $1 out of my personal checking account, does that mean my checking account is bearish? You would say that's ludicrous, okay? Yeah, so it's down, but the question is it down below support? Okay, so those added words are very important here. Do not just look at, it's down, it's bearish. You're not saying the whole complete sentence there. It's down for the day from where we closed yesterday. But if you look at this, we're still trying to hold that moving average, 5,000. So if we hold 5,000, okay, and we start poking above that 51.12, all of a sudden some of those other gold trades or gold price in general, they might try to rip back to the upside. Now, some people say things like it could be a bull trap, things like that. The moral of the story is these are the same people that actually are always scared to get in. we understand collectively that all entries have risk, all of them. So the question is not, is it a bull trap, a bear trap, whatever? Are you comfortable with taking that risk? And why is the investor taking the entry? Well, if we start getting about 51.12, that's a shorter term higher high. You make a higher high, you could actually make a higher low. Stay above the 5,000, that shorter term support is actually holding there. Super quick on the silver front. Silver, we said they had a little bit more work to do, and that's still true. I mean, you got to get above 91 there. The middle of the W is there. The one that's a little bit more risky because it hasn't gone up as much, and neither did it actually hold a double bottom or a higher low. Still silver. That is the one. If someone said, look, I'm going to trade, they're probably trading something like silver where it has a higher percentage fluctuation. And the last one, I just want to make quick reference, crude oil itself. Crude oil is actually holding that symmetrical triangle. Some might call it a pennant. Remember, if that oil pushes to the upside, can the energy sector continue to knock its way up? Guys and gals, we cannot say that this is just today, the previous day before that, previous day before that. Because if we go back to the whole moving averages, the labels, this is where it's funny, okay? We got whereas people were funny, okay? Well, yeah, we didn't really see it. Now, remember, this labels the number of days, counts them, in other words, that were actually where the moving average is a certain color. So, in other words, G1 means that the moving average, the 10-period moving average, that was day one of the moving average being green. 33 trading days later, where have we been? Well, here it is, okay? Now, I know we could have said we're at all-time high, can't go any higher. Okay, look, we got to get sick and tired of saying that. And that's something that we're going to continue to smash, that a high is not a bearish indicator, okay? I mean, think about it. If someone's checking their savings account went to a brand new high, is that bearish? Is it? I mean, does it logically really make sense? It's just emotional, right? So how do we turn those off now? Because I don't like seeing that, because that's annoying me. Tough. Now, if we go back and say actually go to applied okay, now remember, if the energy is doing that, base materials is probably knocking its way higher. Now remember, these are things just recently. If we're talking about saying Cahold, and we talked about that yesterday, that was just brand new yesterday. So what it really comes down to is the trend can go as high as it wants, but it doesn't matter if the investor's not in. And when it comes down to an entry, are you comfortable with the risk that you're willing to take? Or are you? Now, I want to kind of point out one other spot. Financials, and remember, regional banks have actually continued to actually hold up. Those financials, we're going to continue to watch those. But the one that I really want to watch, I mean, we could say industrials, but the one as far as new, probably would say really utilities. With rates pushing down, could utilities go up? Now remember, the investor says, look, I don't like to buy individual stocks. They might try to buy the basket. Now, the basket of utilities, the one of the products that tracks utilities, the group in general, it has a dividend actually coming up. Check me on that, February 22nd. Yield is about 2.9%, 32 cents per share. Okay. Remember, dividends are not indefinite. They can change them. But keep in mind, if the rates go down, some might, for example, trade things that might have that inverse correlation to rates. So, example given, if I go look at, let's say, a stock like, say, like Home Builders, example given, I'll pull up a stock that we might use as a proxy, PHM, Pulte Homes, or Toll, okay? Now, look, we don't need to be in the stock market to know that if you knock the rate down, the potential affordability, assuming they just don't knock the price up on us, the affordability might be better. If you push down the rate, I might be able to afford the house, the condo, whatever it is. And so some of these home builders also got to push. Last week, we talked about Simon Property Group. And if you look at Simon Property Group, some of these real estate names, for the first time in a while, have started to move. Do not forget that when you push down the rates, it pushes up the valuation potentially of stocks. Don't forget that. We good on that? Very important. Okay. Now, let's kind of talk. Let's go back to something just really quick. Now, when we talk about, if I were to ask you, give me some gold stocks you've been looking at, what are they? Which ones? Which tickers? And I promise I won't tell anyone. The only one I'm going to tell is Jack's, because I got to tell him everything. We're buddies. Okay. Now, if I looked at, for example, one of the stocks, like, let me start with AEM for just a second. Now, AEM itself, really, now remember we talked about this, and I love, a lot of times, I love going back to things that we talked about that we continue to see the same patterns on. Why do we keep talking about it? Well, maybe because they're principles that are timeless and practices that are timely. When we get a gap down, draw a line at the closing price. Draw a line at the open of the red candle. Why? Well, because that's where we said support and resistance are. The support, where we fell from, the resistance, where we actually gapped down to. Now, what you're going to notice on AEM, we already started poking our nose through that area of that 202. And what you're now going to notice is if we get above that, the 202, we're now making a higher high. If we make the higher high, well, we could try to make a higher low. Yeah, but we're down here today. It's a red candle. It's bearish. Don't say stuff like that because you're not reading the trend properly. Okay? Now, don't worry. I did the same thing. Okay? It messed me up, and I wish someone would have set me straight. If we get a red candle, that doesn't mean squat. That red candle is just saying it's lower currently than where we open. But when we look at still day over day, it's still higher. So you got to put that red candle in context. And the other thing we want to ask ourselves, is the red candle below the support and or moving average? The answer is no. Now, we got earnings coming up on that. I'm going to look at its cousin that's across the street in the same precious metal neighborhood, and I'm going to use NEM. Now, why NEM? Well, first off, it has not poked its way through resistance. And the first thing is, when we look at the gap down level, okay, we're going to draw the line from the open of the red candle, okay? And then we're going to say, where do we gap down from? There. Now, do you think you could do that? Do you think you could draw a line from where we gap down from? And if it is a red candle on the gap down day, do you think you could draw a line down to the open of that red candle? Do you think you can do it? I think we could, okay? Now, here's the deal. We got earnings coming up right there, okay? Now, if we look at this upside, now I'm going to start with the stock trade, okay? Now, these two markers right here would be A, where we actually, that the open price was. That's a target area. This is a target area. Now, what I'm going to do in this case is I'm going to say in this case, I actually don't know. So we got to ask ourselves, are we trying to hold over earnings? That's a very important question. Because if we're trying to hold over earnings, we might be asking ourselves, well, do you want to set a stock trade where you actually have a gap risk? Do you want to make it where we're trying to do a bullish trade, but at the same time define the risk, right? Do we want to maybe try to play an option trade where we could try to make a slice of that percentage of the maximum gain and not hold over earnings and so on? Okay. Now, I'm going to do this as a stock trade initially. Okay. I'm going to right click on the chart and let's go back to that paid money account. I'm going to bring up NEM. Okay. NEM. And what I'm going to do in this case is I'm going to right click on the current stock price. We're going to go buy custom. We're going to go with OCO bracket. And I'm not going to do it in the margin account because we don't really have any capital left. If we said, well, how much could we really buy, okay, capital-wise, budget-wise? Well, let's say we did $7,000. $7,000 is going to get us right around about 57 shares. Now, the level of resistance that we talked about is 126 and 133. Now, if we said, James, those are kind of close to each other, I'm going to kind of put this in the middle of it. Now, Kelly, Kelly, put that back on there. Don't retract the message. Kelly, I was thinking the exact same thing you were. Caller. Okay, but I'm not going to do it as a caller. Why caller? Well, because if someone said I'm going to hold it over the earnings, Well, they might say, look, in this case, I don't want to have gap down risk, okay? That's undefined unless the stock goes to zero, which isn't very helpful. Now, if you look at this, I'm going to go daily GTC. That's the target. The target I'm going to take right in the middle between resistance number 1 and 2. Okay? Now, if we look at, let's say, the support area, you're going to notice on the stock that the moving averages are now starting to pinch. Could the moving averages start to act like an area of support? Well, if I said, where is that? 115.37 less 2%, that's going to get us 113.06. 113.06, we're going to put it right here. 113.06, dated GTC. So now we could say, well, I like to buy more, and this is where we're going to find out where you really are in your investing. I personally don't care how long you've been investing. Personally, it doesn't really matter. Where you really are is going to be dependent on not how long you've been doing it. The question is going to really tell you where you are is how much are you willing to invest? What's your budget? Answer that question. Second, how much capital are you willing to risk? That is going to really tell you where you are. If you can't answer that question, do not pass go and collect 200 paper dollars. What are you willing to risk? Well, if I looked at this and said, look, if we get in, let's say a 120-ish, set a stop at 113, that's about $7. $7 on about 57 shares of stock. That's really right about $400. If we lose a forecast amount of $400 on an account that's $156,300, what would that really be? And the answer is, drum roll please, 0.2%. So if we lose that $400-ish, we would lose about 0.25%, 0.01, 1%. So if we lose, we're probably not going to feel like a loser completely. It makes me feel bad. Yeah, I lost 0.25%. But the reality is, without risk, there's no reward. Okay? So we're going to buy. Now, how do we know it's stock? Well, stock, and there's no expiration and strike. We're going to go confirm and send. Now, notice this is saying buy $7,000 worth of NEM. Okay? Now, we put in this price right there. That's a limit. That's saying we could buy up to that price, but not more. If you can get filled for less, yeah, okay, send it. And let's watch. Come on. I'll fix that after the class. But if this was going right now, we're probably going to get filled closer to about 120.40-ish or so, okay? Now, obviously, if we're trading an NEM stock, gold, okay, of course, we would be watching what the gold price is doing because NEM sales revenue are reflected based upon not what cotton production does in Alabama, but upon what the gold prices are, okay? So that's why we're looking at the prices that's affecting the sales and the profitability. Now, I want to also go back to just for a quick, one of these other stocks. Now, I want to actually go back to a couple stocks, make mention of something. So when we look at a stock like Amazon, okay? When you look at a stock like Amazon, it was kind of funny where it gapped down and then it rallied back pretty aggressively. Now, where did that close? 222. It ended up the day down about 211. It was down to what, about 4% or so? If we're talking about maybe something that might fill in the gap, it might be really Amazon. Now, remember, Amazon said they were going to invest $200 billion, which is like their operating cash flow for the year, and they were going to invest it. Now, that's like buying a bazooka in a way, financially, right? Why are they willing to invest so much? Well, number one is they might not want to actually spread that money out over time to allow their competitors to catch up or be on pace of what they're doing. They might say, look, we're willing to kind of forego some of the profitability in the shorter term for what we actually think we could do in the future, near term, okay? In other words, they want to get first movers advantage on some of the technology and some of the business. Now, the other thing is that also might, if a company like Amazon is going to invest that much, the other companies might say, man, I'm not even sure if we can compete with Amazon. If some other company says, we're going to invest, let's say, $20 billion, and the other company is going to invest 10 times that, they might say, maybe we don't want to be in the same space that Amazon might dominate in. So you can kind of think of it as a psychological financial play to position themselves maybe at the head of the pack. Now, what that does in the short term is it pushes down the stock price. We're going to go back to, let's say, the trade tab for just a moment. And what I'm going to do is in the margin account, what we're going to do is we're going to try to add to the position. Now, there is a position on the 220 and the 210 right now that's underwater. The 220 strike is the short strike, okay? Break even on that is about 219. Clearly, we need the stock to go up about the next couple of days to get it to the break even, okay? Now, if we go back and take a quick peek at this, we're going to add to this position. And what I'm going to do is I'm going to do right around about the 30-ish delta. That 30 delta, if I go back to the March expiration, 30 delta is going to be right around the 200 strike. That 200 strike, if I go back and open this up to strike with 10, selling the 200, which has a nickel bid-ask spread, and if I buy, let's say, the 195 or the 190, that's going to be about $1 credit if we do a $5 wide spread, or a $2 wide spread, $2 credit, if you will, for a $10 wide spread. So when I said a $1 credit for a $5 spread, there you go, ish, $1.20-ish. If we said, look, I could take a $10 wide spread and still be able to handle the max loss. Well, in this account, I wouldn't be able to handle that because if I lost $800 on this account that's at $43,000, that's about 2%. It's too much. So in this account, we're going to have to actually go back to the 195, okay? Selling the 200, buying the 195, unlock that $1.18 credit. Notice the built-in maximum loss. Now remember, on a stock trade, it's saying if it goes down to that price or less, sell it, but the loss could be more severe. The fill could be worse than what we thought. On this type of order, vertical, there is a defined risk trade on a vertical where you got to remember in this case is we have an obligation to buy and a right to sell at 195. Thus, given the vertical, given a max loss of 382. Now, whenever we see the profit less than the max loss, it's actually saying this is a probability type trade. Now, what we're now going to go ahead and do is got to do that. Got to see what that's actually saying. I got something red. I just want to see what it's actually saying. Okay, it looks like it's saying this place an account into a concentrated position. Okay, and a concentrated position may result in a higher margin requirement. Okay, you want to learn more about that? We don't see that very often. Send the order. Let's see if that actually fills. Now, when we say a concentrated position, there are really two verticals where the risk, we got really two positions that we can see on, well, it is two positions. We have a current vertical and a second one that's trying to fill, okay? Now, what I'm going to do, now the comment is, are we closing the February? No, we're not. We got a couple more days left. I mean, we said inside 4 to 10 days expiration. We're now in that. So by this week, let's say Thursday, maybe Monday's President's Day, okay, next Tuesday or Wednesday, max, Friday, I mean, it's expiration. So probably by next Tuesday, this is either sink or swim point. How much of the percentage max loss do we have? Okay, or max loss, or have we recouped? We know the break even on that is at 219. I need the stock to go up about $9 on 210. I need the stock to go up about 4% to get to the break even at expiration. Okay. Now, I also want to go back to, let's look at a couple, let's go back and look at position that we did last week. Now, I normally don't show an example like this, but how many of us don't like to risk over earnings? Is anyone saying, James, I don't like to risk? Matter of fact, I don't like to kind of be in a situation where my stock could go all over the place. And number one, my unrealized profit or loss is just fluctuating crazily, which I'm not controlling. And the second thing is, or I don't like my capital to be so at risk. So last week, we did an example of a stock of Philip Morris. We have shares of Philip Morris. Those shares were purchased on the date when we started reestablish the portfolio for 2026. We bought that in two different sections, which has really been something we've talked quite a bit about, dollar cost averaging. When you get in a trend, it's usually not that there's only one entry. There's multiple entries. So if there's multiple entries, let's sprinkle some capital along the way. Now I think about this like a relationship, right? The more that my wife loves me, or your spouse loves you, the more you want to share with that spouse, boyfriend, girlfriend, whatever, or your animal, your puppy, whatever it is, right? Well, some investors are thinking the same thing. You show me more trend, I'll show you more capital. Okay? Everything comes back to the market, right? Now, here's what we're going to do. Now, notice what we did last week, which is not something we normally do. We actually sold the 182.5, and we bought the 182.5. Wait, what in the Sam heck is going on here? The delta is it's like close to zero. Now, what does a delta close to zero mean? Well, it actually really means that the stock goes up, it doesn't really benefit. It's insensitive to actually price movement. Stock goes down $5, it doesn't really do anything. Okay, now wait, hold on just a second. Okay, when was that put on? Well, that protection was put on last week. Okay, now if we take a look at this, you're going to see that the call was sold for $610 and it's now $245. Now remember, which side is trying to collect from time decay? Which side? Well, remember, if you sell something, that's the side that has that positive time decay. Now, when we take a look at that theta, if we add that and say which one has positive theta, it's that one right there. And there's a higher theta decay than actually what is decaying on the put. Now, here's what's kind of interesting. We held it over earnings. We still have the shares of stock. The question we want to ask ourselves is, number one is, are we still above support? Which would make sense, because if you own the stock or any stock, you're always wanting the stock above support. And number two is, are we still in that upward trend? Now, as we held the protection over earnings, we want to now talk about the management of this position. Okay, now what are we concerned about? Well, we've got to ask ourselves the question is, have we broken out of an area of resistance? Now, to answer that question, I have to pull up the chart. So what we're going to do is we're going to pull up the chart and go PM. Now, if we pull up PM, what we're going to do is we're going to define the resistance. Now, calling all technicians, where do you see a resistance? Well, if we go back to the chart and say, James, I'm kind of seeing resistance right about, let's say, 182. I'm seeing an area of resistance maybe about 185-ish. Okay, so why do we care? Well, we're saying, look, we're not going to do anything to the caller until the stock breaks out of the area of resistance. Now, what I'm going to do is, if you said, James, I'm seeing right around that 185. Yes. That's what I'm seeing, the investor says. Well, we're going to take 185, and what we're going to do is say 185 times 1.01. What that's really doing is it's taking 185, but then just tacking on 1% above that. Why do we care? Well, we're going to say, look, if you get above 186.85, exit the caller. Exit the caller. Now, in this case, what does that mean? It means buy back the short call plus the long put. And in this case, the long put, and what do we mean by that? We're selling the long put. Okay? Now, how do you do that? All right. Okay, so here we go. Locked down. Ready? Now, so first off, this is kind of interesting because, like, my gosh, we went through it. Now, if you look at this and say, well, we didn't have price risk. Really? We had an obligation to sell the shares at 182.5, which they could buy those from us at any time because they're American style options. Second is we, in this paid money account, have the right to sell these shares. Now, what if I want to exercise my right? Right click and just say exercise. Now, when you right click on the put by itself and you say exercise, what is that saying in English? Well, that's saying in English, if you exercise your right to sell the put, you're selling the shares of stock at 182.50. That's what you're doing. All right. Now, let's hold the control button down on a keyboard, or command if you're using a more superior, or just use a command if you're using an Apple keyboard. Control if you're using a PC keyboard. We're going to right click, create closing order, and what we're going to do is now it's going to come up as a combo. The combo is actually saying the short call and the long put. Now what we're going to do is, now notice we're not touching the stock here, okay? Now I'm going to say create closing order, buy that, and this is just getting rid of the collar. Now we're getting rid of it now? No. Getting rid of it if the stock were to, let's say, push its way to the upside. And if we click on that gear over here to the right-hand side, so we change that order to a limit to a market, day to a GTC, and then we clicked on the gear right there, okay? Now, if we say symbol, method, mark, now we're going to say, look, now I want you to focus on that little sideways V. That sideways V is pointing towards PM, the stock price. So we're saying if the stock price is greater or equal to, what's the price? 186.85, then get out of that collar. Okay. Now, why did I get rid of it now? Because it's not really doing anything right now. It's just still sitting here. Okay. Now, here's what's kind of interesting. If you are a stock investor and you say, man, I tell you, I hate earnings, okay? Well, you might hate earnings based upon that you feel exposed. This is why some people use, let's say, protected puts, okay, or collars if they had 100 shares, because they're actually saying, look, I want to still be in my investment, but I don't want to all of a sudden just have the stock gap down on information that I didn't know was out there, and I didn't know how other investors were going to react, okay? I'm going to go confirm and send. And now what you're going to see is it's saying, look, exit that position if we get above 186.85, and I'm now going to go ahead and send the order. Now that's sitting there. So notice it's just still saying we are still bullish the stock position in general, but we're waiting for the stock to rethrust its way back to the upside. Now, if it gets to 186.85, does that guarantee the stock's going to go up after that? No. If it does go and it gets us out of that collar, the investor could re-examine where's the support and set the stop again. Now, let's go back to a couple things that are getting a little push, potentially. Now, I want to go back. This morning, we actually saw Marriott push to the upside. Now, I'm going to tell you, as people, we always love a good vacation, don't we? We always feel like we deserve a break. Now, in my family, I always tell them, you don't need a break because you haven't done anything yet. Okay, it's so funny. I mean, it's just like, how could you be tired when you haven't done anything? Now, here's the deal. I just always have to joke with my family members, okay? Now, here's the deal. I think it's interesting to note that Marriott, it's really Marriott that's gone to the upside. It's not Expedia. It's not Booking. You actually see Marriott. The question is it moving into Hilton worldwide? Yes. When we see the hotels pushing to the upside. Now, things maybe, you got to ask yourself, is it really Airbnb? No. So it looks like those cleaning fees of exorbitant amounts potentially eating away into the interest of maybe the shares. Expedia itself? No. Booking itself? Investors saying no, thank you. But those hotels, people kind of coming full circle and saying, look, I'll just take the hotel and you can keep the cleaning fee. Okay. Now, if we're talking about vacations, you got to ask yourself, well, where else? If we said, what is a vacation? What is a hotel on the water? Well, Royal Caribbean. Well, CCL. Carnival. Well, we could also say Norwegian Cruise Line. Now, what I'm going to do is, in this example, let's say the investor said, James, I want to actually do a position, and I'm actually thinking that maybe some of these stocks, remember, why did I bring up cruise ships? If we're seeing the hotels go up, the physical hotels are not the only hotels. Let's just call the cruise ships the water hotels, okay? Now, if we take a look at NCLH, let's say, and I'm going to do this because it's lower priced, okay? A lot of people say, yeah, you always pick the ones that are like $300. Okay, what if I don't have that much money? Well, let's kind of use something smaller, okay? Now, if I said, okay, we have the stock on the right-hand side showing us close above the high of the low day, close above the high of the low day. Now, we have this pattern right here, okay, where we go 1 day down, pop right back up, 3 day down, pop right back to the upside, 1 day down, pop right back to the upside, 1 day down, pop right back to the upside. Welcome to what's called the momentum pattern. Very few understand that. I'm telling you, it took me at least 10 years to understand it. The trends that the investor is probably looking for are the ones where the red candles are shorter in duration than 3 days. Okay? Now, if we look at this, I'm going to right-click on this chart, and I'm going to go buy custom with OCO bracket. Now, this is a stock trade. Now, if we said, where might the resistance be on this chart? Well, it is usually not going to be a resistance by itself. We got this area, which is 24.37. The larger the green candle smashing its way into that resistance, that might kind of tell us that that resistance might not be as strong as we think it is. Now, some investors, technicians might say, well, I'm going to wait and see if it breaks resistance. You could always say that. Just take this from observation. The larger the green candle, the more paper-like that resistance level might be. The other thing is, if you're, let's say, a bear and you're seeing this, you're thinking, my gosh, I'm not sure if I like big, fat, large green candles smashing into resistance. That's not really a bearish signal. You get my point? Okay? Be careful of listening to people that are like, well, we've got a area resistance. We'll wait and see what it does. The fact of the matter is a lot of people will build positions not just above resistance, but they'll build positions below the resistance as the stock is making higher lows. Now, the next area of resistance, if we're talking about body, is 26. If we're talking about kind of maybe tops, we're probably saying 26.99. If we kind of split the hairs there, I'm going to say 26.5. Okay? Okay, now Bill actually says, I've never been on a cruise that was not full. I've only been on one cruise. And even then, I literally had my life jacket that was duct taped onto my body, okay, the whole time. Okay. I know. I got issues. I'm fine with that, okay? I'm seeking help. The biggest actually thing is if you take a look at this, 2406, 2650 target, and then the stop underneath. Now, what I'm going to do, like we said yesterday, well, where's the higher low? Well, there's an area. There's an area. Notice that the lines of Seaport are really coming from the Cajol days. The Cajol day itself are green candles. Notice where we drew the lines from. The open price, like we said yesterday. Now, what I'm going to do is if I said I want to set a tight stop, we could take 22.74 less 3%. We're going to set a stop at 22.05. 22.05, okay? So it's saying if we go to that price or less, Sell the shares. All right, let's see if we can get filled. Let's see if we can. Buying 100 shares are Norwegian Cruise Lines, the shares. Target. When we talk about swing trading, we're looking for 6, 8, 10% pushes. It's about 10% if it can get there. Got to stop underneath. That doesn't define the loss per se. Got to see where it fills. We're going to send the order. And that one fills at 2406. Okay? Now I'm out of my time here today. I want you to keep an eye on these interest rate sensitive areas. Real estate, home building. When we also think about that, think about tech stocks. Also want you to keep an eye on gold prices. Watch the middle of the W on gold. Can it reverse? Very important there. Also remember that the precious metals historically have been acting like a consumer staple area as well. Now, I'm out of my time here today. If you have not subscribed to this Trader Talk channel, just do so. Hit the thumbs up button, smash that button, okay? That way other people can find this information as well. Stay tuned for Cameron May coming up next. Also coming up later today, we've got Barbara Armstrong teaching on getting started with technical analysis. So join us throughout the day as well. Remember, with what we discussed, it was done for example, illustrative purposes only. And this has been a class on Investing Master Series as we talk about some of these interest rate sensitive areas looking for some bullish bounces. Thank you so much. Take care. Bye-bye.